Awesome, John. Great to see you again. Hey, listen, as a continuation of our conversation, what a wild ride it's been the last couple of months here. The market has recovered half of its losses already. And believe it or not, there's still an undercurrent of an uptrend in a rising interest rate environment. And why don't you share why that's the case? Because average investors are demystified right now. They need this thing demystified for them.
Well, you guys have done a great job for years and years, not just recently, talking about how rising interest rates, markets have gone up in rising interest rate environments. Now, it's all based on velocity, guys. If we see a massive jump like we saw in, for instance, 2021, when we had a very quick rise in interest rates in the 10-year in particular, and it just exploded to the upside, that's what spooks markets. A slow, steady rise. I'm not saying that we want to see 3%, but certainly pushing over 2 and to 235, 236, and so forth for the 10-year rate. That has not been the impediment that some of the bears wanted it to be, because again, it's about velocity. If it's slow and steady, and then maybe it gathers itself for weeks or months at a certain level, I think the market can deal with it just fine.
Who heard of organic rate movements, John? Because we know all that stuff is orchestrated, just like you said. But there is an X factor on the markets, and that's Ukraine and the deglobalization aspects. And what could happen in Europe going forward is they might go into a recession much further than anybody realizes because of the disconnect in Russia. And so tell us, how does that affect the S&P 500? Because there isn't a company on the planet that doesn't have exposure today in terms of that stuff. So tell us what you think there.
Well, and that's 100% right, Jeff. Even though I don't invest in Europe, Europe invests in us. They're nearly 40% of all investments in the United States come from Europe, believe it or not. And that's for a host of reasons, not the least of which is liquidity. But also, we can't dismiss Europe as a bloc that buys stuff from the United States, not just invests here, but buys things from us. So the stuff they buy from us has become more and more expensive because the dollar has been moving up like this for the last year, and it's accelerated in 2022. If Europe continues to buy at a similar pace to what they've been doing in the past, Jeff, then we're going to be just fine, even if European equities do what I think they'll do, and that is, just as you implied, have a lot of trouble because they've got a war going on right on their border, and they've got energy prices skyrocketing, food prices skyrocketing, because Ukraine and Russia are the breadbasket of Europe, just as the United States is the breadbasket of the world.
Tell our investors and our viewers and our listeners what sectors they should avoid, and what sector is the worst right now and which sector is the best in this environment. What do you like and dislike?
Well, I mentioned them already, sort of. Uranium, so CCJ and UU are two plays that I am in, full disclosure. I own both of those stocks because Germany was going to shut down their nukes, Jeff, and now they're not. They've shut down all but 6, but now they're going to keep those 6 open because otherwise they wouldn't have enough energy to keep their houses with electric power rather than some of the gas that turns turbines from Russia. And I think overall, energy is going to be a space that you want to own for years. It won't always hover around 150, which is my target, but I do think we get there, and it holds higher in Europe than it does in the United States. That separation between Brent and WTI could be pushing out to record levels over the next several months.
Well stated, sir. Well stated.
Thank you.
All right, Jeff Small, Jon Najarian, it's great spending time with you both here on The Income Generation. Thank you.